Investing has become much more popular since 2020 during the lockdown, especially investing in options, and you can see this in the explosion of Wall Street Bet subscribers. In February 2020, the subreddit Options had about 165,000 subscribers, and now they have 811,000 subscribers. Options used to be a really intimidating area of investing, and you heard stories about people making huge amounts of money and losing huge amounts of money. And then there was these funny Greek letters that nobody knew what they meant, and they were really expensive to trade, and people only traded options because nobody knew the difference between buying and selling options. And futures, what were they? Were they the same thing, or were they different? Nobody knew. There weren't any YouTube channels talking about this stuff, and if they were, they're really kind of dry and boring. The financial crisis of 2008 happened. Warren Buffett called derivatives financial weapons of mass destruction. Nobody knew what derivatives were, but options were derivatives, and Uncle Warren says they're bad, and nobody can touch options, and you only touch options if you're gambling. But some investors knew that you could use options to create steady streams of safe, reliable income. It was reasonable to earn double-digit income from safe, reliable companies, and the math is on your side if you do it right. Selling options, not buying options, was the way to bet on the house. You become the casino, and instead of hitting home runs, you're consistently hitting singles time and time again. You won't make millions selling options, and they won't make you retire early, but selling cash-secured puts and covered calls will help you retire earlier. So you might want to look at options as an asset class and how they can benefit you and your portfolio to help achieve your financial goals. In this video, we're going to give you 5 traits of successful option sellers. So if you want to earn safe double-digit yields, a way to make money regardless of what the stock market is doing, this is a video that you might want to watch. Before we get to the traits, I'll ask you to subscribe to the channel because we're putting out videos every Monday, and if you like what I'm doing, please hit the thumbs up button so more people can see this video. Okay, now that you've hit the thumbs up button and subscribed to the channel, we'll get on to the first trait. These traits aren't in any particular order, but I do think there's something special about the 5th trait that carries over to all areas of life. So even if you're not involved in options, you might still get something out of the 5th trait. Trait number 1, it applies to all the areas of investing, not just options. And it's super important. This trait is diversification. The idea behind diversification is that asset classes behave differently. Stocks go up and bonds go down, and you never know when an asset class is going to go up and down, so you just have to buy a bit of both. So this applies to options as well because the underlying security of an option is some sort of stock or bond or ETF. A good rule of thumb is that no position should account for more than 5% of your portfolio if you're using leverage. And if you're not using leverage by selling cash-secured puts or covered calls, maybe 10% or 15% per position size may be more acceptable. But you should try to build your portfolio up so you can reduce your position sizes or find lower priced positions. We need to be aware of sector risk as well. Things like Wells Fargo, Bank of America, and the Spider Financial ETF, XLF, they all have lower share prices. They're around $40 to $50, but they're all in the financial sector. So if there's some bad financial event or something the Fed comes up with, all these different securities are going to act in a similar way. But it's pretty easy to sell options in different sectors with the different sector ETFs like XLF for financials, GLD for gold. You can earn premium by selling on the bond market with the ETF TLT. Tech sector has the Qs, and you can even do different countries with country-specific ETFs. Hopefully, with a diversified portfolio of puts and calls. You'll be able to reduce your risk and your volatility in case of something bad that could happen in the world. Trait number 2 is managing your risk. There are a few different ways to measure risk when it relates to options. If we sell an option with a strike price that is close to the current price of the stock or ETF, we can earn more money in premium. But the more money we receive, the more likely it is that the options will be exercised and we'll need to buy or sell those shares depending if it's a put or call. We're being paid to take on more risk. Now, the most common way to measure this risk is delta. Delta measures the change in price of the option for every dollar and change of the underlying security. So if we have a call and the delta is 0.25, the stock goes up $1, the option will go up by 25 cents. If we have a put option, the delta will be negative 0.25. Because the delta on puts is negative, stock price goes up, the option's going to go down by 25 cents. Delta is also used as the likelihood of these shares being assigned to us at expiration. Whether it's a put or call, we use the number of delta. So a delta of 25 means there's a 25% chance that the option expiring in the money, and that we'll need to either sell or buy the shares. Now, you can sell your options with a strike price closer to the current share price to receive the more money, and maybe you don't care if you get the shares assigned to you, but if they are assigned, any change in the underlying stock price, that's going to outweigh the premium that you received in the first place. Now, there's some times that you can sell options for much more premium than usual. And if you see this big jump in premium, you may be tempted to sell puts and calls against it. This can be because they have an earnings call coming up. During earnings, the company can make a surprise announcement that can swing the stock up or down. And that's why that premium is higher, because the market is pricing in big news or big possible news. To reduce the risk in our portfolio, it may be a good idea not to sell options during an earnings call. Intel just fell 10% recently on a bad earnings call. The third trait of a successful option seller is to keep a log. A common mistake option sellers make is that they don't account for their trades correctly. And you're going to need a log to keep track of all the money that's coming in and going out to make sure you know how much money you're actually making. If you sell a put contract and earn $100, but now you have a contract with a $70 strike price, that means you have a $7,000 liability on your books. It's not until this contract expires worthless that you can say that you made $100 on this trade. When the shares get assigned, then the accounting can be a little debatable. But I believe if the shares are assigned, that $100 counts towards your cost basis. Then, when the shares are called away, you can add up all your premium and your strike price to see if you sold for a profit or not. Number 4 on our list is to stay disciplined. It is easy to say to yourself that you're not going to sell puts during an earnings call, but you see that high premium and you think, I'll just risk it. What's the worst that can happen? Then Intel drops 10% in a day. I'm not saying that happened to me, but it happened to me. Stick to your rules, whatever they are. Avoid earnings calls, avoid meme stocks, do monthly contracts only, do weekly contracts only. Keep your position size in check. You might make a little less premium, but when your discipline drops, it tends to spread. You're a little lazy with that earnings call, or maybe you go a little bit over your position size. And then soon you stop filling out your log, and these things happen slowly over time, and you get lazy. Then something big happens, like the COVID correction, and all the things that were meant to protect you are gone. Then you're on Wall Street Bets posting how you blew 5 years of gains in a week. Trait number 5 is take responsibility for your mistakes and learn from them. This is much like how Ray Dalio says pain plus reflection equals progress, or his first principle, embrace reality and deal with it. We all make mistakes. I sold that contract on Intel. I knew it had an earnings announcement coming up. I knew that unexpected news can come out during an earnings announcement. I sold the put anyways. I can only take responsibility and learn. It will take a lot of covered calls to reduce my cost basis to break even on those Intel shares. So I need to be more disciplined when it comes to earning calls. I cannot blame the stock market or Intel or anybody else because that's outside of my control. I can only control my own actions. If something goes wrong, and things always go wrong, you need a plan for it. With things like position sizing, diversification, having some rules in place. When something bad does happen, what can you learn after it's all over? This trait of taking responsibility and learning from your mistakes can be carried over to all aspects of your life. So maybe this is the most important one. That is my list for now. There are other traits, and these traits aren't in order of importance. And you can probably find traits that you think are more important than these traits. What trait would you add to the list? Please leave a comment down below. I feel like this video can get pretty long pretty quick if we wanted to add more traits. So we'll just leave it at these 5 traits for now, and we can expand on it in the future. Please hit the thumbs up button. I'd really appreciate that. Subscribe to the channel if you haven't, and I want you to go have a good day, alright? Justin out.